All right. So getting back to, to the work that we were doing before, the Chapter 11 work, we spoke about depreciation. I think most people are pretty solid on depreciation. We also spoke about partial periods, like what if you buy the asset sometime during the year. And then I skipped over dispositions. I came back to it, but we spoke about group and composite depreciation. Like if you have a group of assets combined together, sometimes companies will just calculate a depreciation percentage for that group. So they'll base it on a fraction that is the actual depreciation divided by the cost of all the assets together. This is shown in the textbook. It's not a topic that we spend a lot of time on, but I also just wanted to highlight again what we said before, is that sometimes companies come up with their own, as they call it, tailor-made depreciation methods, and those are even still accepted to a large extent because depreciation at its core is an estimate, as long as the method is consistently and systematically and rationally applied. There needs to be a level of predictability to it, right? So when you go into practice and you go and work and you see something that doesn't necessarily look like what you recognize from the textbook, you first have to ask the question of what method are we using, and make sure you understand it before you say, oh, this is wrong. Okay, because it's possible that the company could be using its own method of depreciation, and it is applying it consistently, and that is allowed. And then there's a whole other, especially for smaller companies, they often just use depreciation methods the same as what the IRS uses, and the IRS has all this information on their website about different types of depreciation methods that are allowed. And sometimes, just to make life easier, companies will just use a depreciation method for their accounting books, the same as what the IRS will use for tax, so they don't end up with a difference between the two, which could result in something called deferred tax. And you guys will learn about deferred tax in later accounting classes. All right. So we did speak also about dispositions or disposals, right? Getting rid of the asset. We said that could happen through a sale or through retirement. We also saw it to some extent in Chapter 10, when we spoke about non-monetary exchanges. So I just, we're going to do a quick example on this. So I'm just highlighting this again, that when you have a disposal, you calculate a gain or a loss as the difference between the consideration received, which most of the time is cash, some type of selling price. And from that, you subtract the book value. And book value is a defined term as the original cost minus the accumulated depreciation on that asset. And you have to remember that depreciation is calculated up to the date of sale. So if the asset's being sold somewhere in the middle of the year, normally the depreciation calculations happen when we are about to issue financial statements. But if an asset is being sold at a point in time when it's not time to calculate depreciation, then we will just calculate depreciation on that asset, because you do have to record all the use of the asset up to the date that it was sold. And for retirements, it's the same idea. You compare the consideration to the book value, except that with the retirement, you're not actually getting any money. You're just taking the asset out of use, right? Out of circulation, basically. And then there is this possibility that an asset could be held for sale, but not actually sold by the time that we are issuing financial statements. And at that point, we do, I told you it's almost similar to what we did with inventory in Chapter 9, where we say lower of cost or net realizable value. So what GAAP requires is for any asset held for sale, if you're doing your financials, you have to measure it at the lower of the book value, which we know is cost minus accumulated depreciation, or the asset's fair value less cost to sell, right? Fair value less cost to sell is basically net realizable value. And if the fair value less cost to sell is less than the book value, you have to take a loss immediately in the current period. Typical instructions from GAAP. Take the loss in the period in which it occurs. If the fair value is more than the book value, you do nothing. And every time, if the asset just stays there and it hasn't been sold, every time you issue financials, you revisit the calculation to see whether there's been any change. So this formula is for when the asset is actually being sold or disposed of. This whole discussion is you want to sell the asset, but you haven't been able to sell it yet. So you have to keep measuring it at the lower of book value or fair value minus cost to sell. All right. Because, you know, it's just this very typical way that that GAAP looks at things. It says, yes, you're holding this thing for sale, so we can actually predict approximately how much you're going to get for it. And if what you're going to get for it is going to cause a loss, we want the loss to be recognized now, even though the asset hasn't actually been sold. All right, so I did put up, for those of you who are following along on Zoom notes and examples, or whatever this thing is called here, yeah, Zoom notes and examples, I did put up the class examples. Previously, I just put up the depreciation example. I went through and added some more class examples for us. So this is a new document that can be downloaded. The only change I made on the notes was I just fixed the heading to match the textbook. So you don't really need to re-download the notes, but the examples and the example solutions were not there before. So if you are, if you are following along on with the documentation, then make sure that you download the class examples. All right. So so actually, let me just give you like 2 minutes until 10:55 for those who want to download the document with the examples. I'm gonna have you take 2 minutes and get into Blackboard and just download them quickly. And while you do that, I'll just take the attendance. So again, I'm giving you time to download the page of examples on Blackboard if you haven't done so already, or if you want to be able to refer to the questions as opposed to taking pictures with your phone. Is Jalari here today? No. Madeline? No. Marina? No. And Christopher? Okay. You still have about a minute to download the examples. If you want to download the solutions as well, you can. Just try to make sure. Yeah, go ahead.
How did you get to this Google Doc?
How do you get to the Zoom to this one?
Yeah. Which one
Yeah,
is it?
I'm saying the class examples is this one. Yeah. Class examples F21. Do you see that? All 21. How do I
It's
get
in
there?
the
It's on
document.
Blackboard. Sorry. Are you asking me where am I?
Yeah.
I'm sorry, I misunderstood your question. I'm on our Blackboard. So you have to go into your Blackboard. Are you able to get in there, Eric?
Yeah, I'm there, but which one is it?
Okay,
No.
gotcha. Zoom notes and examples.
Okay, gotcha, guys. Thank you.
No problem. So Blackboard, Zoom notes and examples, chapter 11 materials, chapter 11 class examples, fall 21. For anybody else who's still trying to find their way there. And then, of course, you can follow along the calculations on the spreadsheet over here. You just click on it and it should be able to give you access to the spreadsheet. All right. Okay, so I'll give 1 or 2 more minutes because it sounds like people are still navigating their way to Blackboard and or to the document. So in the meantime, if anybody has more questions, I'm here, but I'm just going to give you 2 more minutes to find your way to the actual examples. Okay, Jalari, I just took attendance, but I see that you joined, right? You just joined. So I'm gonna mark you present. Jalari, are you there? Oh, hang on, sorry. Okay. Jalari, we're in chapter 11. I was just directing the class to Blackboard, to Zoom notes and materials. Oh, sorry, Zoom notes and examples. Chapter 11 materials. We're gonna continue with the chapter 11 examples, number 3 specifically. And I just wanted to make sure that people could find that information if they didn't want to keep taking pictures of the questions and whatever we've been doing in the past. All right. So that's time. Now that I've given you about I don't even know, 6 or 7 minutes, most people should have found their way to Blackboard. I'm going to have us do this number 3 disposition. You'll see that it's fairly much in line with disposals that you've dealt with previously for assets, but we'll do it so that you can understand that when we're talking about how to calculate gain or loss, that these things are the same across the board. So Fanseth Farms Inc. purchased a tractor in 2015 at a cost of $30,000. The tractor was sold for $3,000 in 2018. Depreciation recorded, so you see how here it says through the disposal date. That means that they recorded depreciation right up to the point of sale, which is what they're supposed to do. So the depreciation total, $26,000. Prepare the journal entry to record the sale. So that's the first one. And then afterwards it says, now assume that the tractor was sold for more, right? For 10,000. So we'll start with a sale for 3,000, right? In this exercise. And so I'll go down here. All right. So for exercise 2, which is the other depreciation example, I'll just say C solutions because it's the same as the one we did yesterday. So I'm not going to do that again. We don't have time for that. So exercise 3 is what we're doing now. And it's asking us for journal entries. So it's going to be debit and credit. All right. So the first thing to remember is that there's basically a 3-step process when we are recording a disposal. You're getting rid of the asset and the accumulated depreciation related to it. You're recording the consideration, in this case, cash that is received, and you're calculating whether there is a gain or loss. And you can do the debits and credits however they shake out. But those are the 3 things. You get rid of the asset, get rid of the accumulated depreciation, record the cash, and record the gain or the loss. So here we go. Cash debit, right? Cash is going up 3,000. Accumulated depreciation, the contra asset is usually a credit balance. To get rid of it, we are going to have to debit that contra asset. And if you want to say accumulated depreciation on the tractor, you can. Sometimes they, differentiate between assets. So that was the 26,000 that is now being eliminated, right? And then at this point, you don't know if there's a gain or a loss. So, you can skip a line and just get rid of the actual asset, right? Tractor, 30,000. And now, you can balance the journal entry. So we can do that. We can say, okay, there's 30,000 on the credit side and there's only 29,000 on the debit side. So it must mean that we need a $1,000 debit so the debits and credit dollar amounts can be equal. So then that is the loss on the sale, right? That's as simple as that. But let's look at what's happening for a calculation. You're saying I received cash of 3,000, and now my book value is what I compare that to. The book value is the cost minus the accumulated depreciation. That's 4,000, right? So that's 30K minus 26K. So then we're in a negative situation because the cash that we received is less than our book value. So this is going to be a loss. So either way, whether you do whether you do the plugging of the number in the journal entry or you actually calculate gain or loss as the difference between cash and book value, either one is going to end up giving you this $1,000 loss. Does anybody have questions on that? All right, so, since there don't seem to be any questions, let us have you guys complete the next one. When the asset is sold for 10,000 instead of 3,000, I'll give you 5 minutes till 11:07, probably too long, but it's fine. Give you 5 minutes to do the journal entry for when the asset is sold for $10,000, and I'll have a volunteer have us or get us to the answer at 11:07. You can raise your hand and I'll take a volunteer. Okay, so do the example where the asset is sold for $10,000 instead of 3,000. All right, I see Jaren's hand is up. I can take you at in a few minutes. In about 2 minutes, I'll take the answer from you, and then Antora and Gianna can hopefully take you for an example later in the day. So 2 more minutes. All right. So Jaren, go ahead and tell us what you put down.
So cash debit.
Yes.
So
Oh, sorry. Hang on.
10,000.
1,000.
accumulated depreciation,
Mm-hmm.
26,000.
Mm-hmm. Yes.
Tractor
Yeah, put
trading,
that. Okay, I know this is gonna be a gain, so I just check. And
trading
check the 30,000, yes.
gain of sale of tractor,
Mm-hmm.
6,000.
All right. And if we again want to see the gain or the loss situation, we will say how much cash did we get? 10,000, right? What's the book value? Still 4,000 because it's the same assets, right? So the gain, thank you, Jan. The gain is 6,000. Good. Any question, anybody about anything? Simple, right? Hopefully it's as simple as can be. Okay, so that's the end of an example of a disposition because that's really as easy as it is. You either you either calculate your gain or your loss this way, or you just balance out your journal entry. And most likely the system will want debits first and then credits. So you can maybe just write out your journal entry on a piece of paper and then punch it in with debits listed first and then the credits listed afterwards. All right, so that was exercise 3. That's also the disposition stuff. I think that you've probably had enough time to take that down. So I'm going to go back here to the notes and we'll start talking about depletion. All right, depletion. And depletion is like depreciation, but it's for natural resources. Okay, so it's basically just a different name that is given for. I'm sorry, I'm having some type of, I wouldn't call it allergies, but something is bothering my eyes and my nose. So it's used to account for natural resources and they are actually consumed over time. So you think about timber, right? If it's a paper company that's using up timber, or if it's a mining company that has a gold mine or diamond mine or whatever, or it's an oil company that has an oil rig that they're setting up and drilling. All those things are natural resources. And of course, as you use them up, you have to account for the fact that they've been used, right? When you first acquire them, you're going to record an asset. We did this in chapter 10 when we did the asset retirement obligation and natural resources and so on. You probably remember that you first record the asset, but then as you use it, you obviously have to account for the fact that it's being used. So just like we have a depreciation base when we depreciate our property, plant, and equipment, with the natural resources, we have what's called a depletion base. And the depletion base is just going to be the sum of all the costs of that asset minus any residual or salvage value that we can get at the end. And I'll show you how to do that. This is kind of a reminder from chapter 10. There's an overlap here, right? Because these two chapters go together. When we come up with the cost of and we'll do an example here in a few minutes, so don't worry if it's not entirely clear. I think it will become clearer with the example. When we do and we did do an example in chapter 10 also. So if you want to revisit that, you can. For the cost of the natural resource, you are allowed to obviously include the acquisition cost, whatever you actually paid for the property, any exploration costs. So if you buy a mine and you have to still drill down and look to see if it's worth putting in a shaft or whatever it is that you're doing for oil, also to see where exactly to start drilling in the area that you've acquired, those exploration costs, they all go into the cost of getting the asset to the location and the condition where it's ready for its intended use. And then we've got development costs. So once you've decided, where you are going to do your work, let's say for the mine or for the oil rig, then you actually are going to develop that area. Maybe you're going to, or I should say for drilling the oil, you're going to build a rig, you're going to build a shaft to go down in the mine, or you're going to do whatever you need to do. Both intangibles, so maybe some type of designs that you have to come up with. There are tangible equipment costs that go into it, but these are not included in the depletion base. So if I say, oh, I had to buy, one of these diggers, these construction diggers in order to get the mine going, that thing will be recorded and depreciated separately from the mine itself. But if I say I had to get someone to draw up plans so that I know exactly where to mine, those intangible development costs are included in the depletion base. And then the last piece, sorry, just excuse me, I need to blow my nose. Sorry about that. I seem to have had some type of sudden onset of irritation in my nose that I needed to deal with. So to come back to the last one, restoration costs, which is, what we spoke about when you do any damage to an area that has natural resources, you have to restore, often by law, that area to its natural state. And so you have this, what we call an asset retirement obligation, which was what we calculated in chapter 10 when we did all the present value and all of that, with the table that we used. So that also forms part of the cost of the asset, because you won't be able to actually use the asset if you don't agree to restore the area. Normally by law, again, you have to sign a contract and so on. So for the depletion calculation, companies normally use the units of production, units of activity method, which makes sense, right? Because you're saying, if it's a mine, like how many tons of whatever coal or whatever it is are we mining per year? If it's timber, how many trees are we going to be using or cutting down per year? There's an actual unit, if it's oil, how many barrels of oil are we extracting per year? There's an actual unit of production that can be measured. That makes more sense than saying, oh, I'm going to deplete this mine over 5 years, because of those 5 years, maybe the first 2 or 3 years, you're really getting stuff out. But by year, 4 and 5, there's not much happening. But now you've got depletion expenses that are equal instead of using, some type of activity-based method. And so we establish a depletion rate by saying, what's the depletion base, and we divide, by the total estimated units available. And depletion base is the total cost minus the salvage or residual value. And then here's where things get a little bit weird. The depletion expense is often credited to the asset itself. This also happens with intangibles, I guess, because GAAP understands that the asset is actually being used up. It's different to a truck, right? When you depreciate a truck, for instance, the truck isn't going anywhere. The truck isn't disappearing over 5 years. But with something like a mine or timber or something, that asset is actually being consumed in reality. So the expense can either be credited to the asset, although, you can use a contra account, so you can use an accumulated depletion account, but for the most part, they will just say debit depletion expense, credit coal mine, or credit, timber forest, or whatever you call your asset. Okay, so that's setting the scene for the depletion stuff. Does anybody have questions on the theory? Otherwise, we'll go into actually doing an example. All right, so we'll go to the example. So yes, 2 depletion examples. One I'll take and one I can throw back to you guys to do. So I'll start with number 4 here. Everly Corporation acquires a coal mine. So there's the acquisition cost of 400,000. Intangible development costs total 100,000. So remember, we said that intangible development costs do get included in the cost of the mine. After extraction has occurred, Everly must restore the property And then look there, we've got the fair value of the obligation. They've already given it to us, 80,000, after which it can be sold for 160,000. That's the residual value or salvage value. This is, I think, the same fact pattern as the example we had in chapter 10, but there we weren't asked to do depletion. Everly estimates that 4,000 tons of coal can be extracted. This is the total number of units of production, right? That's the overall how much you can get out of the mine. And then it said if 700 tons are extracted the first year, prepare the journal entry to record depletion. So where we start is we have to first get to a depletion base, right? We have to calculate what amount we're going to deplete. Then we have to calculate, the depletion unit expense, and then we calculate depletion expense for the year. So I'll take you through all of that. And again, most people hopefully have downloaded this from the Blackboard. If not, just take a quick picture, but I will go between the question and the answer. So the first thing here, again, is to calculate the depletion base. And to do that, we're starting with the acquisition cost. And we know from the question that that was 400,000, right? If you go back here, it was 400,000 to buy it. Then you've got your intangible development costs, and then you've got your asset retirement obligation. So here goes the intangible. So that's 100,000. And then the restoration costs per the question are 80,000. So if you were being asked, how much is this mine gonna be in your books, it would be 580. Oops. So that's the total cost is 580, but now you're gonna get rid of the salvage value or residual value. It means the same thing, 160,000. So you subtract that 160 from the 580. Or 20, and this is called your depletion base. All right. So this is what we're going to deplete. Now, so this is the first step, right? Step 1 is determine your depletion base. In step 2, you're going to figure out what is your depletion cost per unit, right? That's you get a dollar amount per unit that you will have to figure out the cost of. So it's going to be the depletion. So it's a formula. So let me say it's a formula. It's the depletion base divided by the total units of production. That's the formula. Oops, that's not where I meant to do that. All right, so over here, we're gonna say, so that equals the 420 that we just calculated divided by, let's go back and see what they say. Supposed to be 4,000 tons total, right? So 4,000 is the total units of production. $105 per unit. Okay. And now in the third step is where you can calculate depletion expense. It's going to be the depletion. So this is, let me also just say that this is a formula. This is going to be the depletion cost per unit multiplied by units for the year, or units of production. Let me say that for units of production for the year. So if you look at it on the question, it says that it's 700 tons are extracted for the first year. So that's what you have to use. So you're going to say 105 is the depletion cost per unit multiplied by 700, right? Units. So that's going to give you, or let me say 700 tons, because tons is the units of production. That gives you 73,500. That's your depletion expense. I have to excuse myself again to blow my nose. I don't know what is going on. Just give me a second. It feels like there's dust somewhere in this room that's getting me down. Anyway, thanks for your patience. No big deal, right? So 73,500 is the depletion expense, but we haven't actually answered the question. What the question said is prepare the journal entry to record depletion. So I'm still going to do that. So debit, credit. And it's, like if you think about depreciation, it's kind of the same idea that there's a depreciation expense and, accumulated depreciation, but things get even a little bit more crazy here because we're not going to use depletion expense at all because what we pull out of the ground is not an expense already. It is inventory for the company. So it's going from being the asset, the coal mine asset to being inventory because, was this a coal mine? I may be mistaken. Yeah, okay. It's going from being a coal mine and changing into inventory because all this coal that is being extracted still has to be sold. So you're gonna feel like you're going a little bit crazy now because I'm putting inventory as the debit. And why? Because the coal, right, I'm gonna write it here, the coal extracted will be sold, right? It's not yet an expense. So it's not going to be depletion expense. And then the credit also no accumulated depletion. Remember, I told you that and it's in the notes over here that the depletion expense is credited to the asset. You can use a contra account like accumulated depletion, but because the asset is actually being consumed, it does make sense to just credit the coal mine itself and not use an accumulated depletion account. Questions, folks? I know this inventory thing is a little bit crazy, right? But just think about it. The coal that is being extracted will be sold. So this inventory becomes cost of goods sold. Eventually, it's not yet an expense. As depletion expense, it becomes an expense when it becomes cost of goods sold. Any questions, steps 1 through 3? Nothing? All right. Well, in that case, let's have you do, and this should be quick because this stuff is not too taxing. Let's have you guys do this depletion example with Fitzgerald oil. I'll read it to you and then I'll give you some time and you can do it and then we'll take a break. So Fitzgerald Oil and Gas incurred costs of 8.25 million for the acquisition and development of a natural gas deposit. So there's the acquisition cost and the development costs already. The company expects to extract 3 million cubic feet of natural gas. So 3 million is the total units of production during a 4-year period. You can kind of ignore the 4 years when it comes to calculating the depletion cost per unit. You're concerned with the units of activity, right? Natural gas extracted during years 1 and 2 was 700,000 and 800,000 cubic feet respectively. What was the depletion for year 1 and 2? So I'm going to give you 5 minutes until 11:31. Take a picture of the question if you still haven't downloaded it from Blackboard. So take your picture quickly. I'll go back to the previous example, give you 5 minutes, and then I'll take someone who hasn't volunteered yet to give us the answer to exercise 5. All right. So I'm going to leave exercise 4 up here. Let me make it a little bit smaller so I can put everything onto one screen. I'll leave that up to help you. You're doing exercise 5 until 11:31, and then we'll go through the answer together. Do we have someone who wants to give us to volunteer or? Okay, Antora, I see your hand, so I will take your answer. Go ahead. Oops.
So we have a cost for 8,250,000.
Yes. Mm-hmm.
And unit of production 3 million.
Yes.
So cost per unit is depletion base by total unit of production
Yeah.
is 8,250,000 by 3,000,000 2.75. Yeah.
Right. Perfect. Yes. Thank you.
So
And-
for
mhm.
year one depreciation, we have depreciation cost per unit into unit of production 2.75 into 700,000.
100,000. Yes.
We got 1,000,000 925,000.
Good.
And for 2 year 2.75 into 800,000
Yes.
2,200,000.
Perfect. So let me ask you one more question after this, if you would like to do this, otherwise I can do it. Do you think you want to attempt to say what the journal entry might be for year one?
For year one is inventory
Good.
debit 1,925,000
Good.
and coal mine credit.
Was this a coal mine? I can't remember. I just want to make
Sagen
sure.
wir mal die
Oil, natural gas. So gas, I guess,
gas. Oh,
gas line.
gas.
Something like that.
Yeah,
I know, but
didn't want
natural
to.
gas, it's like a gas pipeline or something. That's what they call it. Thank you.
Yeah.
This is correct. The question didn't ask for this, but I just wanted us to make sure that we understand again that inventory, and you got it right, Antora, so thank you. That inventory would be the debit because the company is now going to go on and sell the gas, the natural gas, onto whatever consumers it's working with. Thank you so much. All right, so that's exercise 5, folks. Any questions on that solution there? All right, so when we come back from our break, we'll move into intangibles, to amortizing intangibles and what that entails. And, time, as time permits, we'll also go into some issues around what happens if you change your estimate of depreciation and so on. So it's 11:34. Let's start back up 11:45. It's just easier to remember 45. And then we'll just keep plugging through the chapter. All right, 11:45. I'll be right back. Apologies for the delay. I got caught up in an administrative problem. So we're back, and we move into intangibles now. Let me just make this a little bit bigger so we can see what we're doing. So remember, this chapter is about property, plant and equipment, natural resources and intangibles, their use, the utilization, and also any type of impairment. So we're going to talk about how to amortize intangibles for a bit and do I think there are like 2 examples of that. And then after that, we'll move into other things that are slightly more, the things that we've done so far. Hopefully you can agree that it hasn't been too bad, like it's from a difficulty perspective, but the things that are coming, the impairments, the change in estimates and things like that are a little bit more complicated. So just be aware of that. So the cost of an intangible with a finite useful life is amortized. By finite, we mean that the useful life can actually be counted in a number of years. So things like patents, copyrights, and so on, there's actually a finite useful life, whereas things like Goodwill, which was an intangible that we spoke about in chapter 10, that doesn't have a finite useful life. It's a indefinite life intangible. It's not amortized, and we'll see later that it's tested for impairment instead. So you allocate the cost, there's any residual value, this becomes the amortization base. Remember, we had a depreciation base, we had a depletion base, and now we're calculating an amortization base over the asset's useful life. We generally expect the residual value of an intangible to be 0 unless there's anything else stated. I think we have one example where there is a residual value because this company can sell a customer list that they have on after they're done with it. But for like a patent or something like that, generally the residual value is 0 because when the life of the intangible is over, there's no further value in that asset. We mostly use a straight line method. Remember last time on Monday when we spoke, we also said straight line is generally what is used by companies because it's easier, but with intangibles especially, there's no real unit of production type of approach because that's not really how we look at it. It's just a straight line amortization. The useful life of an intangible asset is determined by law or by contract or by its actual usefulness, not necessarily. And so sometimes the legal life is longer than the actual useful life. You always go with whatever is the shortest. So if the time period is less than the legal life. So if a patent's legal life is 20 years, but its useful life is less, you go with a lower. So let's say its useful life is only 10 years, then you're going to have to amortize it over 10 years. Because remember, amortization, just like depreciation, is about actual use. So if you're only going to be able to use that thing over 10 years, even though legally it's a useful life of 20 years, it doesn't matter. You go with 10 years. Amortization expense, same deal like with a depletion. You can use an accumulated amortization account, a contra account, but most of the time they just credit the asset itself. Sometimes the questions will give you guidance to say, the company uses an accumulated amortization account, or it will just say that say nothing, at which point you could do either one of those. And then, like I said, indefinite life intangibles like a Goodwill or a trademark are not amortized, but they're tested for impairment. All right, so that's the setup for this. Does anybody have questions about the theory around intangible assets before we do some examples? All right, so let's move right into it. So here's intangible amortization. You may recognize this example from chapter 10. I mean, I don't expect you to, I'm just saying you may, if it sounds familiar, you may recognize it. It's now just building on what we learned in chapter 10, where we just recognized the customer list. Now we're actually going to go ahead and amortize this customer list. So it says that assume that Green Market Inc. acquires the customer list of a large newspaper for $6 million on January the 1st, 2012. The customer database includes the name of the person, the contact information, the order history, and the demographic information. So at the time when we went over this, I said to you, this happens sometimes when you subscribe to something and you maybe don't realize that in the fine print, right, written somewhere, it says we have the right to sell your information over to someone else. And then suddenly in your mail, you start seeing all kinds of weird quote unquote junk mail, right, that you didn't sign up for. That's usually because companies, are selling your information around between one another. Green Market expects to benefit from the information evenly over a 3-year period. So they paid 6 million for this thing. They expect the life of the intangible to be 3 years. Green Market determines that it can sell the list for $60,000 to another company at the end of the 3 years. So that's what is the residual value or the salvage value, right? At the end of 3 years, they can sell it for 60,000. So we do not amortize that piece, and we will subtract it as part of calculating the amortization base. So in A, they just ask you to prepare the journal entry to record the customer list. That's going to be, easy enough. And then in B, we have to record the amortization for the year. So I'm going to go ahead and do that one over here on our Google Doc. All right. So because we've seen this example before, I'm not going to spend too much time here. The debit is to customer list, which is obviously an intangible, right? The value of the asset is much more than the Excel spreadsheet or the paper or the database or whatever that the customer list is contained in. So debit customer list, credit cash, right? That's was it on January the 1st? That's the journal entry for that. And now we're going, so that was A. And now in B, we are going to actually calculate the amortization. Very simple. In the first step, you're going to calculate an amortization base. So you're going to say cost, and then you're going to get rid of the salvage value or the residual value. So the cost over here, same cost, 6 million, right? The salvage value is 60,000 that's mentioned in the question. So that's the amortization base, 5,940,000. In step 2, you're actually going to calculate, you're actually going to calculate the amortization expense. This is very similar to what we did with the asset yesterday when we were doing straight line depreciation. Same thing, right? You're just going to take the 5,940, 1, 2, 3 divided by the 3 years, the 3-year useful life, and it is going to be 1,980,000 per year. All right, just going to turn this off for a second. Okay, so prepared, but it's not done. Prepare the journal entry to record the amortization for the year. So we've got the number, but we need the journal entry. So here goes the journal entry. So it's going to be amortization expense. No inventory for this one, right? This is not inventory. This is a straight expense. You've actually used up the customer list for the year. And you can now, we come to this place where you have an either or. You could say accumulated amortization, which I think is I don't know, I don't know, in practice it could go either way. Or you could put customer lists, right? You're allowed to do either one. It depends on what the company prefers. And that's the amortization for the year. Okay, so the process again, record the asset. When you're doing the amortization calculation, you look for a salvage value because that has to come off to make the amortization base. And then the expense is just straight line divided by the number of years in the useful life of the asset that was given in the question. And then debit amortization expense, similar to depreciation expense, and credit either accumulated amortization or the asset itself. Questions, anybody? Seemingly fine. Okay, I'll give you a few seconds to just take down any information if you need to. Okay, so we move on. That was the customer base. Now we have, let me see if it's, this one is pretty similar. So I'll leave this one out because you have the answers already. And it's not much different to what we just did. Let's look at number 8. So I'll say for exercise 7, just see the solution, because you're just going to be reporting a pattern and then amortizing for the useful life. There's not even a salvage value, so it's very simple. So this was from the 9th edition of the textbook. I'm not sure we need to even make that distinction right now. So in number 8, another intangible question, a little bit more information, a little bit different from the other two. On January the 2nd, 2018, David Corporation purchased a patent for $500,000, okay? So they bought a patent, probably even have to journalize the purchase. The remaining legal life is 12 years. Okay, so that's the legal life. But the company estimated that the patent will be useful only for 8 years. So now the question is, which one do we use for amortization? Do we use the remaining legal life or do we use the 8-year useful life? Remember what I said? You're going to go with the lower amount, right? Because you're going to amortize over the period that you can actually use the asset. So since it's only useful for 8 years, you just ignore the 12 years and go with a smaller number of years. In January 2020, the company incurred legal fees of $45,000 in successfully defending a patent. So here you have to cast your mind back to chapter 10, where we spoke about the acquisition of intangibles. In that chapter, it said that you can capitalize, meaning make into an asset, the costs, legal expenses that you have related to successfully defending a patent. If you're unsuccessful, you can't capitalize it because that means you weren't actually able to defend your patent, so there'll be no future benefits from your patent. But for a successful defense, you can actually put those costs onto the cost of the patent. So this $45,000 will be recorded as a patent when we get to the point, or as part of the patent when we get to that point. The successful defense did not change the company's estimated useful life, so we don't need to have a change in estimate. We just continue with regular amortization over the 8 years that we had before. So they asked for journal entries for the patent for 2018, which is when we purchased and yeah, you have to be careful of these questions, all right? Because it's just saying, give us a journal entry for 2018, 19 and 20, but 2018 is not just the purchase of the patent. You also have to record the amortization expense for 2019. There's no activity with the patent itself, but there's amortization expense. For 2020, there's the successful defense of the patent, and most likely, although I didn't put it into the journals, but now I'm thinking there should probably also be an additional amortization expense. Yeah, I'll do that when we look at this separately. Okay, so let's start with 2018 with January and start there. So exercise 8. Again, stop me at any time if you guys are lost for any reason. It seems that people are generally either just quiet or actually following what's happening. So January the 2nd, 2018, we purchased the patent for $500,000. And we assume that it's paid in cash without any other information being given to us, right? We have to make that assumption. And so now when we come to the end of the year, we probably have to record amortization expense, right? So we're going to debit amortization expense. Amortization expense. And we're gonna, in this case, I'm just gonna credit the patent to show you another way of doing it, right? Before we were using accumulated amortization. And how is that gonna work? This is very simple. It's just gonna be the 500,000 divided by the 8 years, right? So I'm not even gonna do a separate calculation because there isn't even a residual or salvage value. There's really nothing to this calculation. So it's going to be 62,500 for the amortization expense. All right. That's it for 2018. In 2019, we're just going to go right to the end of the year and literally do the same journal entry, right? Because it's over 8 years, we're, recording the same amortization expense, right? And then the question says that in January, we successfully defended our patent. So because it's successful, we can actually, I'm not sure what date exactly, but we're going to say January 2020. We debit the patent. This is where it's a little bit different. It's not going to be legal expense or something. You can actually capitalize the legal expense to the patent. We assume that it's paid for in cash. Now, what I didn't see, this question is from the textbook, and what I didn't see in the textbook and what I'm thinking is a little bit weird is that they didn't do an amortization expense, for 2020. So if we had to do that for 2020, it would still be amortization expense and patent, right? Notice how the accounts are exactly the same, but instead of doing 500,000, obviously it's going to be 545,000, right? Because you're adding the additional 45,000 onto the cost of the patent, still divided by 8 years, not because there's 8 years left, but the life of the asset is 8 years. So I don't know if let me think. 2 years have passed. So I don't know if we should. We probably have to do it slightly differently. Let me do it a different way. I'm going to say 500,000 divided by 8 years is one part of this, because I realized that we can't just lump the 45,000 plus, and then the 45,000 is still in the same useful life, but 2 years of the 8 years have passed. So the 45,000 is going to be for 6 years. I hope you follow that. The 500,000 was always the cost of the patent. It had an 8-year useful life. And so, 2 years of the 8 years have passed. So when you add the 45,000 on in January 2020, you can't do 8 years because there's not 8 years left anymore. You have to do 6 years. All right. So let's do 45,000 divided by 6 plus 62,500. And I'll go check in the book. I don't know why they didn't do this extra step. It may be there, but I don't think I saw it. So questions on that last piece, because that's not, if you're looking at the solution simultaneously with me, you'll see it's not there. I was just thinking, as the class was going, that it was a little bit weird that they didn't do an amortization journal entry for 2020 when they've said you have to do all the journal entries for each of the years. Does anybody have questions about this? All right. Crickets, so no questions. Okay, so now we come to part of the work that's a little bit more involved, changing the estimate for changing estimates for your depreciation calculation, depreciation, depletion, and amortization. But for the most part, the examples just deal with depreciation, although it would be the same, I guess, mechanics, the same process if you did the other two as well. So what does this mean? Remember I said at the top of the discussion, even, on Monday, that depreciation is an estimate. It's a cost allocation, systematic and rational cost allocation of whatever asset you purchased, but it is an estimate. And specifically the things that are estimates that go into the calculations, not the cost, I mean, that's obvious, but the salvage value is an estimate. You're estimating on day one of the asset's life how much money you think you'll get at the end of the asset's life. So that has to be an estimate. Secondly, the useful life of the asset is also an estimate, because you're saying, you know, I think I'm going to use this asset for 3 years or 4 years, 5 years, whatever the case may be, but all assets don't behave the same way. Or maybe you just started your company and you're coming up with, you know, number of years that you use particular assets related to your company, but that may or may not be, you know, appropriate. Sorry, I just saw a typo there. So it's an estimate, and so GAAP allows for the fact that the estimate could change. It allows for the fact that companies may realize that the useful life that they previously had for this asset is not appropriate anymore. The useful life may have increased in years or decreased, right? They also allow for the fact that the salvage value could change, and that the company's salvage value changes by so much that they actually have to change their depreciation calculations, all right? So this is talking about the same thing, that these calculations require estimates of useful life and residual value or salvage value at the beginning of the life of the asset. There may be some changes. A change in estimate is accounted for prospectively, meaning going forward only, not looking back. And why not looking back? Because an estimate is based on your best understanding of the information that you have at a point in time. So at the point when the estimate changes, that doesn't mean that you're saying, oh, you know, 5 years ago, I should have known this. You didn't know it because information has come to light today that causes you to change your calculation. So you'll never find that a change in estimate is going to be a retrospective adjustment of the books. You're only going to change it for the current period and future periods, okay? And you don't have to justify, you don't have to disclose in the financials, right? You're not required to disclose justification for a change in estimate, because again, it's accepted that that estimates could change. So you don't have to write out in the footnotes of your financials like, oh no, you know, we suddenly realized that this asset that we have actually has an 8-year useful life instead of, you know, 5 years. People understand that this, I mean, you can say that this changed, but you don't have to say why it changed, because they understand that an estimate could change. This is contrasted with a change in method, right? This one is a change in the estimates that go into the calculation for depreciation. A change in method means you're changing from straight line to units of activity, or units of activity to declining balance, or declining balance back to straight line, or whatever the case may be. GAAP does allow changes from one method to another, but you have to justify, as the company, you have to justify the change. You can't just jump from one depreciation method to another without a proper reason for why you are actually doing that. So, you know, I can't decide, like, you remember on Monday, we did all those calculations and we saw that double declining balance had like a depreciation expense of 200,000 in the first year, whereas straight line was only 90,000. I can't decide next year, oh, you know, I want to change from declining balance to straight line because I don't like how big these numbers are. I have to have a better justification than that. All right. So change in estimate, we get it. Estimates change. You don't have to tell us why you're doing this. The market changes. Change in method from straight line to units, or declining to straight line, whatever, you got to tell us why you're doing it. And more often than not, the reason has to be around you know, making the financials where it's easier to understand, or this is more like in line with your business or something like that. It has to be a proper reason. And these changes, again, are prospective. Okay, so you don't have to go back, you know, 5 years and change all your financials for the fact that you're changing from straight line to, you know, sum of the year's digits. You don't have to go back and change everything to sum of the year's digits. You just change the current year and all the future years. All right, so we will do examples on change in estimates. The change in the method examples, we will, as long as you know how to do the methods, we don't have to go through a change in method. You do need to know, though, that both of these, the changes happen prospectively. And this one requires, does not, require justification, and this one does. So let me see here. The error correction is not so much doesn't tie in as much with these two because these are changes. The error, I'll just talk it through. You guys already kind of know what we mean, but I'll talk it through. Because of the nature of depreciation, amortization, and depletion, if you think about the accounts that are involved and so on, it can affect multiple accounting periods if there was some type of actual error. I'm not talking about salvage value is different to what we thought it would be. That's an estimate change. I'm talking about like you took the wrong cost, of the asset when you first started depreciating it. And now you realize that when you went back to look at the receipts or whatever, that you should have typed in 100,000, but you typed in 10,000, for instance. That's an actual error, right? And because depreciation is happening over multiple periods, obviously, if you find an error, many accounting periods could be affected by that error. So how do we treat a material? Remember, it has to be material, meaning that this error is so big that if, this error had not happened, people may have made different decisions about, the financial statements, right? And materiality is different for every company because every company's numbers are different. A big company would have a materiality number that's much bigger than a small company, obviously. So I can't tell you, $10,000 is material. I'd have to look at the error in light of the rest of the financials. But if there's a material error, and when you guys are auditing one day at PwC or Ernst & Young, Deloitte or KPMG or BDO or wherever you end up auditing, you figure out that even as auditors, your job is not to find fraud and to find errors. You're working at a level of materiality and you're basing your work on samples. And so, if a material error is found, it would have to be fixed. But again, it has to be material. You're not telling your client to fix errors that are tiny because that would just be a waste of time. What we used to do, and I think they still do this though, is you keep a spreadsheet of all the errors and things that you find to make sure that together, all those errors don't add up to a material amount. I can't just say, oh, I found 1,000, yes, no big deal. Oh, 2,000, no big deal. But eventually when I start adding it all together, I'm like, oh, that actually adds up to a material error in the financial statements. Okay, so what do we do if we find an error? The previous year's financial statements have to be retrospectively restated. What a nightmare, right? So especially if this is a public company, they would have to go back and fix all the previous year's numbers, have everything re-audited and reissue it. Plus they have to issue a statement to say that there was an error. And you can just imagine, what a field day the analysts would have with that. That could even impact their stock price depending on what the error is. So obviously we don't want an error to happen, but if it does happen, everything going back has to be fixed, right? All the accounting balances have to be corrected. So, depreciation expense closes out to retained earnings. So that means retained earnings is wrong. That's on the balance sheet, but also all your net income was wrong, but most of it has been closed out already. Current year's income statement, they have to be fixed. Balance sheet has to be fixed, you name it. If the retained earnings has to be corrected, the correction is a prior period adjustment to the retained earnings, and you have to have a footnote to describe the whole mess and how you fixed it. It can be very complicated to fix an error. I've worked at clients where they had errors. The easiest way to do this is to say what happened, like what was the journal entry that was made that was wrong. So have that in front of you. Then you say, what should have happened, right? What are the journal entries that should have been made? And then you compare the two and out will pop the correction that you need to make, okay? So don't try to look at the error and say, oh, I'm just gonna fix it by trying to do my own thing. Ask yourself, what happened, what should have happened, and what journal entry do I need to make to fix the difference, right? So that's errors. Any questions on these things before we move on? Okay, so let's look at an example of a change of estimate. There's two examples here for change of estimate. One is for the number of years has changed, right, for the useful life. That's number 9. And in number 10, the useful life changes, but the salvage value also changes. All right, so that's kind of building on what we know. So just to set the scene here, this is usually happening, and it's happening in this example where the company has purchased an asset, it's been depreciating the asset for a few years, and then in one of these years, the company suddenly realizes that this asset is going to, in this case, have a longer useful life than what they have actually been, thinking, and so they have to change their depreciation expense to reflect that. So let's read the question and then we'll see how to actually tackle it step by step. So assume that International Paper Company purchased machinery with an original cost of $90,000, right? So there's your cost. It estimates a useful life of 20 years with no salvage value. However, during year 6, so during year 6 means that 5 years, right, of depreciation have already been taken, right? And now we're in year 6 when this change is going to happen. So don't get confused here. During year 6 doesn't mean 6 years of depreciation have been done. We're saying what's done already 5 years, and now in the 6th year, we're trying to see what's changed. International Paper estimates that it will use the machine for an additional 25 years. So the total life is going to be 30 years, because remember, 5 years of depreciation is already taken. And this is a very key word, additional. You have to read so carefully, because you could just say 25 years and say, oh, it's going to be, and the useful life is now going to be 25 years. No, it's 30 years, the additional 25 years plus the 5 years that have already been taken instead of 20. So it asks you to calculate the amount of depreciation expense to be charged in year 6. It asks for the journal entry for year 6, which is obviously dependent on the depreciation charge. And then it's asking you, should you make any changes to prior periods or opening balances as a result of the change in estimate? And for this question, you go right back here and you see that a change in estimate is prospective, which means it's only the current and future periods that we have to change. So for this question, we already know that the answer is no. You don't have to change prior periods, you don't have to change opening balances, but we'll take it one step at a time. So let's start with part A. All right. So the best thing to do with this type of question is to calculate how much depreciation has already been taken, and then to figure out what is the book value of the asset at the point where you are changing the useful life, because it's that book value that is left to be depreciated. And so that's what's going to be part of the calculation. So I'm going to just write out steps that you need to do. Right, so step 1 says determine the book value of the asset at the end of year 5, right? Because you want to know what was left to be depreciated, and based on what's changed now, we will use that number. So the cost of the asset was 90,000. That's given in the question, right? The initial useful life, maybe instead of just saying useful life, we'll say the initial useful life to just differentiate, was 20 years, right? There's no salvage or residual value. I'm just going to put it as 0 so that we can, if we have other examples where there is a salvage value, you will remember to put something in there. So then what was the depreciation expense, right, per year? Very simple. You're just going to say 90,000, right, divided by 20 years, 4,500 per year. This is 90,000 over 20 years, just in case anyone's wondering where that came from. So that's 4,500 per year. How many years did we depreciate? 5 years already depreciated, right? So if that's the case, then it must mean that 4,500 times 5, that's how much accumulated depreciation is already on the books related to this asset. 4,500 times 5 years. So then what is the book value, right? The book value is defined as cost minus accumulated depreciation. So we can figure that out. It's going to be the cost of 90,000 minus the accumulated depreciation of 22,500. So 67,500 is what is left over. So I'm going to just write a sentence here. The book value is what is left to be depreciated, right? At the beginning of year 6, when the company is making the change in the estimated useful life of the asset. Okay, so we don't go back and say, oh, the useful life is now 30 years, so let's go back to 90,000 and divide it by 30 years and change everything from the beginning. You're not supposed to change. It's prospective, right, from the current year and moving forward. So everything that happened in the past is gone, right? We need to make changes prospectively, right? That's important. Current year and future years. So you don't go back, you just move forward with this. So the way you're going to do this now is in step 2, right? You're going to calculate the new depreciation expense per year. And if you, I mean, you can do this however you want to do it. I find that if you just be very systematic and follow the steps, you should be fine, right? So you go with whatever the book value is, which in this case is 67,500. We just calculated it. And then you look for the remaining useful life, right? So it said an additional 25 years. So the remaining useful life is 25 years, not 30 years, not 20 years, not some other amount, not 24 years, because you counted 6 years, 25 years additional time, right? Additional 25 years. And then your depreciation expense is going to be simply this, right? Book value divided by the number of years, 2,700. So it's 67,500 over 25 years remaining. This is the depreciation expense. Questions on any part of this before I make the journal entry? This is normally something that people struggle with for whatever reason on the tests, but that's also why I try to be very specific on how to get to the answer. Any questions? Nope. Okay, so we go to B then. B asks us to make the journal entry for the depreciation expense in year 6. So a depreciation journal entry is kind of like a, you know, type of slam dunk entry. You already know the answer. It's debit depreciation expense, right? And credit accumulated depreciation. And it's the same 2,700, right? The new amount. Notice how this amount is obviously less because we've increased the number of years over here. So, you know, when if you want to do a sanity check on your work, if the number of years has gone up, and of course, you're also depreciating less of a balance, this number can't be bigger than your original depreciation expense. Okay, it has to be smaller. And then C asks that question about should we be adjusting prior periods? And we know that the answer is no. Changes should be made to the current and future periods only for a change in estimate, which is what this is. All right, questions? You're still with me? I hope so. I hope people aren't sleeping there in your little black boxes. I can't see you. I hope that you are okay. I just want to point out that this book value, I forgot to write this in. It's like maybe to think of it, it's like the new cost of the asset, okay? I think that's important to think about, especially when we have a salvage value to work with, which we'll have in the next example. Treat this like a new cost. So if there's a salvage value, you're still going to deduct that salvage value from the cost. Okay, so in the next example, there is a change of two things. As I said before, we're changing both the useful life and the estimate of the salvage value. So let's see what's happening. Same company, just a slightly different fact pattern here. These people want to tell me something. Assume that International Paper Company purchased this machinery with original cost of 90,000. That's already known. It estimates a 20-year useful life. But here's the change now, right? With a salvage value of 10,000. We didn't have that before. However, during year 6, we noticed that the estimate changes and we now have an additional 25 years. Okay, so that's the same as above. Its total life, therefore, will be 30 years. And the revised salvage value is 8,000. All right. So same A, B, and C, but a wrinkle here. We can't just do the same calculations because we actually have a salvage value to deal with. So let's figure this out. Okay. So it's the same thing, right? Step 1, you're going to do the old depreciation. You have a cost of 90,000, right? You have an initial useful life of 20 years. You now have a salvage value, which you didn't have before, right? Of 10,000. Okay, so your depreciation expense is going to drop because you have to subtract the salvage value from the cost before you allocate the depreciation. So you're going to say 90,000 minus the 10,000 salvage value. Oops. Minus the 10. This isn't going as great as I would have liked because I moved the thing around. Okay, so let's do brackets. So 90,000 minus 10,000 divided by 20 years. So 4,000, right? 90K minus 10K over 20. All right. So 4,000 depreciation expense per year. So obviously then for 5 years, you're just going to multiply the 4,000 times 5. And that's going to be your new, or not new, your old accumulated depreciation. Okay, someone's noise is on. Who's making, whoever was making a noise, are you muted?
Y viendo para atrás, viendo para atrás, tú estás.
Okay, hang on. Okay. All right, so 5 years is 20,000. So now the book value at the end, right? Because remember the first step is to calculate the book value. I can never spell this. So it's going to be cost minus accumulated depreciation. 70,000 is the book value. That's step 1. Step 2, you're trying to calculate your new depreciation. And what you do is you take the book value, which is like the new cost, right, of 70,000. You have to look at what is the remaining, or yeah, okay, let's just put the remaining useful life. It's still going to be 25 years, right? Because that's what the question said, an additional 25 years. And now it's a revised salvage value or the residual value of 8,000, right? Based on the question. You go just to confirm, salvage value is 8,000. So your depreciation expense now, you're doing this. Oh my word. What's going on? don't know what's happened. I seem to have I seem to have lost some portion of the work. Oh well, I think you can, I'll show you on the solution sheet in a minute, but I think you can follow. So it's book value that's remaining useful. I tried to undo and redo, but it seems like there's some other issue. I think I did undo too many times. So that's revised salvage value. So the new depreciation expense is going to be the cost minus the salvage value, right? So that's a new depreciable base of 62,000, and you're going to divide that by 25 years. So 2480, right? So again, it's the cost minus the revised salvage value divided by the leftover years. 2480 is your new depreciation expense. Again, if you just be systematic. The touchpad is so sensitive on this computer, and I think that's part of the reason why my husband gave me some step to follow to make the touchpad less sensitive, and of course I haven't done it yet. So that's why the screen sometimes does its own thing if I hold onto the touchpad too long. Anyway, so that's this is the new depreciation expense. And then for B, we're just making the same journal entry again. So what's changed? It's really just the salvage value, right? So here's your cost. Let me just populate this stuff so you know what is your initial useful life, salvage value, depreciation expense. I put here that it was for 5 years, so that's accumulated depreciation, and that was book value. So that's the process. Now you're going to do your debits and credits. Was it asked again for journal entries? It's going to be depreciation expense of 2480. And it's going to be accumulated depreciation for the same. And the answer for C, same story. Should we make a change for prior periods? No. And I'll just write no. I'll just copy the answer from above. It's again, change in estimate. There is no. Oh, it seems I've also, I don't know what happened yet. It was like a catastrophic event that took place in column B because all the stuff that I had out there is gone. So no, right, changes in estimates are made prospectively, right? Current and future periods only. Just bring this up. So this solution is complete. All right, so questions there as I tried to fix whatever went wrong in column B. Anybody need me to give them any further explanation? All right, so okay, I'm just fixing whatever gremlins came in here and messed up my stuff. So that's the end of change in estimates. Hopefully easy enough to follow. If you follow the steps, where people go wrong with this is that they usually count the years wrong. like they'll see, you know, that in year 6 or in year 5, something happens and they count 1 too many years of depreciation expense. So make sure when it says in year 5 or in year 6 that you understand you only count up to the year before. And then in the current year, you make the new, that's what it's saying, change in estimate is in the current year and in the future years. So you make the new calculation for the current year. So normally that goes wrong. Normally they forget that when you calculate the new depreciation expense, you don't start with cost, you start with the book value that you just determined above here. And those are 2 of the typical pitfalls that I've seen happen with this work. Okay, you will have change in estimate examples in your homework that you can practice on. All right, so you know this chapter is again like a whole lot of small things, you know, I wouldn't, maybe not small, but there's a lot of different topics that are included here. So please be careful, make sure that you are actually reading and paying attention, because there's a lot of moving parts in this chapter. You know, we have a few minutes left, and I'll just set the scene for impairment, which is going to be, you know, the next topic. We've got impairment, and then after that, we will have something called subsequent expenditures, which is just like what happens if you make payments for your assets after the fact, whether it be repairs and maintenance or additions and things like that. But just to come back to impairment of value. So when we think of this word impairment, if I say that my eyesight is impaired, because I actually do wear glasses, my eyesight is impaired if I have to look far away, that means that it doesn't work as well, you know, as it used to. So an impairment with asset is the same. You have depreciation where you're allocating, you know, the cost of the asset on a rational and systematic basis. But an impairment is when there is a loss in the usefulness of the asset that is more than you would have expected just from the regular, you know, use day to day. So something happened. It could be a market condition changed. So, you know, suddenly there's no longer as much demand for a particular product. So, you know, the machine that was producing that product is not going to be as useful to you as you thought. So obviously GAAP doesn't allow you to just say, oh, well, that's too bad, I'll just keep depreciating it at the rate that I was before. You actually have to stop and say, basically you're asking how much cash do I think I'll be able to get, you know, from this machine over the rest of its useful life versus the book value, cost minus accumulated depreciation, versus the book value that I'm carrying it at the moment. And if you find that what you can make off of the asset, in this case a machine, is less than what it's at in your books, then you have to actually take a loss. Remember this constant theme with GAAP, that you have to take the loss in the period when it happened. Even if you didn't sell the thing, even if it's not completely broken down, you have to take the loss. So that's what impairment means. It means that there's some type of loss of usefulness that is bigger than just the day-to-day wear and tear and depreciation, right, of the asset. And we split the impairment into, you know, a few different categories. Okay, you've got there's basically 3 categories of impairment that we will deal with. We will start by looking at how do you handle, right, in terms of calculations and journal entries, how do you handle an impairment for property, plant, and equipment, and a finite life intangible? Remember, finite life intangible means an intangible that, you know, the useful life is known, right? So that's a particular process that we follow. You know, you start with something called the recoverability test, where you basically say, this is the amount, like I said, the amount of cash that I'll be able to get from this asset. This is the book value. If the cash that I can get, it's called the undiscounted cash flows. If the cash that I can get is less than the book value, then the asset may be impaired. And then I have to go and do a second step to see whether the asset is actually impaired. So for the first group, PP&E, property, plant and equipment, and finite life intangibles, we follow this recoverability test, and I'll show you how to do all of this next Monday. And then for the second group, it's intangibles that don't have a finite life, they have an indefinite life, but not goodwill. And I should probably say, but not goodwill, because goodwill has its own separate process. So indefinite life intangible, like let's say a trademark, for instance, since that thing has a life that goes on however long, you can't calculate the cash flows that you're going to get from it, because they could go on into perpetuity forever. So you do a different type of test. It's called a fair value test, where you just do one step. You ask, is the fair value of the asset greater or less than the book value? If the fair value is less than the book value, then the asset is impaired and you take a loss. Again, I'll go over all of this on Monday. And then goodwill has its own separate impairment test, because goodwill comes about as part of an acquisition. When one company buys another company, goodwill is tied to, you know, all the assets that were purchased, and they often call it a reporting unit. It's basically tied to the business. You can't separate goodwill out as its own separate thing that will have fair value on its own. So when we do an impairment test for goodwill, we actually have to look at the entire business and say, you know, is the fair value, and we call it a reporting unit, is the fair value of the reporting unit less than its book value? And at that point, we can start calculating goodwill impairment. So that's the overview of impairment for you guys. Again, you know, come ready next week, Monday, to really dig into this. It's probably, you know, in this chapter, probably, especially the goodwill impairment, is probably a little bit more complicated than the rest of the stuff. And then after we're done with that, we just have subsequent expenditures, which won't take us very long. So by Monday, we should be wrapping up this chapter, which means we'll be on time, and then the homework will be due on Wednesday. So if you are concerned that you want to finish the homework over the weekend, please note that over here, I've given you all the solutions to the class examples already. So if you want to see, you know, for the rest of the examples, I think the examples go up to like 19 or 20, but 3 of them are just goodwill impairment examples. If you want to work ahead, you're welcome to do, you know, the examples on your own. But like I said, by the end of Monday, you'll know how to do it anyway. And on Wednesday, you can obviously ask me more questions about the homework or ask me via email. So that's where we will leave it today. I'll stop the record.